This is a chart of the average stock market return in each calendar month for the last 100 years. 9 of the 12 months have posted an average increase, February and May have been pretty much flat, but then there's September. It's a massive outlier. Stocks on average have declined by 1.17% since 1928. And look at how stocks have performed in September over the last 10 years. It's consistently negative even while the stock market has increased a lot. The phenomenon is called the September effect.
We did see more stocks in the S&P 500 move lower.
Is this just simply September seasonality, or is there something else to this?
And that is becoming a bit of a self-fulfilling prophecy.
The 9th month of the year is historically much weaker for stock market returns over the past century. This year has been no exception so far, falling as much as 4.25% in the first week, and this is where it sits today. But there's a lot more to the story than just comparing the performance of each calendar month. I wanted to find out why this is the case, so I took the 30,000 daily price measures of the S&P 500 and put together some visualizations that really get at the heart of this so-called September stock slump, as well as why this year, September 2024, may end up being one of the worst for stock returns in a very long time. Let's start with what it is exactly we're looking at. What do people mean when they say the stock market? Well, in one sense, it just means a composite of all the publicly listed companies. And since the US stock market is by far the biggest, it gets the lion's share of global attention. Today, we use the S&P 500 index as a representation of the stock market. It contains the 500 biggest US listed companies with a value of about $48 trillion. And despite being just 500 companies, they represent the value of almost 90% of the thousands of public companies. So it's a pretty good measure. But we didn't always have the S&P 500. The index was created on March 4th, 1957 by S&P, Standard & Poor's. At the time, those 500 US companies had a total value of $172 billion, which, as a side note, means the US stock market has increased by about 279 times in the last 67 years. So if that isn't incentive enough to buy and hold the index, I don't know what is. And according to Reuters, 69 of the original 1957 S&P 500 companies were still in the index as of 2014. For stock market data before 1957, we have to look at previous iterations of the S&P 500. Before S&P was S&P, it was called the Standard Statistics Company, and they developed their first stock market index in 1923, which tracked 233 US companies, but only recorded prices on a weekly basis. Their first daily price tracking index came in 1926, a 90 stock index, which at the time was considered a good representation of the overall market. There are other indices such as the Dow Jones Industrial Average. It's been around since the late 1800s, but is composed of just 30 companies, so the S&P index is believed to be a better view of the broader market. Ultimately, that means we have really great data on the daily price movements of the US stock market for nearly 100 years. And I've broken down that data in a number of ways, such as comparing September to other months of the year, how performance has varied across different time periods, and looking for correlations that might explain why its outcome is so different from the rest of the year. Before we get to what I found in the data, I want to go through some of the more common ideas and theories that have been suggested over the years. The first is that September comes right after the US summer school break. From May, June to the middle of August, American schools are closed and many families take this 10 to 11 week period to go on vacation. So one theory is that investors liquidate some of their stocks at the end of the break to offset the vacation and next schooling period's costs. If the stock market has done well in the first part of the year, like it has in 2024, investors are able to lock in some of those gains. There's also the tax loss harvesting theory that because September is notoriously a month where prices are down, investors can sell some shares to lock in capital losses that will offset their capital gains when the financial year finishes in a few months. I sort of just touched on it there, but there's another theory that comes from behavioral finance that essentially suggests that the September effect is just a self-fulfilling prophecy. That simply the expectation of September being bad leads to more selling of stocks. If that was the case, then you'd also expect to see some selling in August, people trying to get ahead of the September slump. And you sort of see that, with July averaging 1.7%, followed by just 0.6% in August. But truthfully, all of these theories are just guesses. It might in fact be completely random. After all, one of the 12 months of the year has to be the worst. Spoiler alert, it's not entirely random, but certainly looking just at the average return of September isn't enough. So I looked a lot deeper into the data, and what I found was actually rather interesting. The first thing I did was graph out the return of the stock market in each individual September going all the way back to 1928. And what we see is a whole lot of variance. September 1963, for example, looks pretty much like the average figure. The market in that month fell 1.1% compared to the 1.17% average across the 100 years. But in 1939, stocks rose 16.5% in September. And in 1931, stocks fell, but they fell by almost 30% in September alone. So clearly the negative 1.17% September average figure doesn't tell us the whole story. Not only does that figure not tell the whole story, it's just also flat out misleading. This is the return of stocks in September every year. Not only is there a huge amount of variance, the return is positive about 44% of the time, which is pretty significant. Almost half of the time, the September stock slump doesn't even occur. But that's not the end for the September effect. The fact that almost half of the time the effect doesn't actually happen seems to suggest that it's completely random. And it is random, but not entirely random. Take September of 2008, for example. This was a really bad one, down 9% for the month. But that shouldn't at all be surprising, because 2008 was the height of the global financial crisis. The unemployment rate was approaching double digits, the economy was contracting, and for the full year in 2008, the market fell 38.5%. Then we could look at 2019, a year where the September effect didn't work. Stocks rose 1.7% in the month. But again, in hindsight, this isn't surprising. The market was coming off a correction in late 2018, and the Federal Reserve was cutting rates from the middle of the year. I remember 2019 being a good year, but I forgot just how good it was. The market was up 28.9%. At least in these two examples, the return we see in September is largely influenced by the economic factors happening throughout the year, not the September stock slump. So I graphed the annual return of stocks with the September return to see if there was a correlation. And there is. A 0.56 correlation coefficient, which indicates a moderate positive correlation. Or, in other words, while September has averaged a negative return, a decent proportion of the variance we see year to year can be explained by whatever else is happening in that particular year. Which brings us to today, September 2024. In the first week of the month, the market fell about 4%, which is why you've probably seen a lot of talk about the September stock slump. But hopefully throughout this video, it's becoming quite clear that if September is negative this year, it probably has little to do with summer vacations. It will instead be influenced by the various economic factors at play over the next few weeks. And there's a lot of them. So far, there's been the weekly jobs report. It showed that the labor market had added fewer jobs than expected, which is generally viewed negatively by the market. That was followed by Tuesday's manufacturing data, which also came in quite weak. So for the month of September, it looks like this so far. Looking forward, the Bureau of Labor Statistics will release their monthly Consumer Price Index report. In fact, it may actually be out already, depending on how fast I edit this video. I'll put the report on screen now if it is out. On the 18th of September, the Federal Open Market Committee, or the FOMC, has its September meeting. For the entire year, the Fed has dangled the rate cut carrot in front of us. First, it was 6 rate cuts in 2024, then 4, then 3, and now likely 1 or 2. But it is highly anticipated that the Fed will cut rates at this September meeting. The only question really is whether the cut will be a typical 25 basis point one or a 50 basis point one. Most people think the cut will be 25 basis points. And I know polymarket isn't exactly a scientific view of market consensus, but I do find it kind of funny that you can now bet on this stuff. The first presidential debate between Donald Trump and Kamala Harris is happening as I'm making this video. With two very different sets of economic policy, the outcome of the debate may also have an effect on the markets. I go into this and other more important factors for the end of 2024 in this video, if you're interested. So while you're likely to see a lot of talk of the September effect or the September stock slump over the coming weeks, it's actually just pretty much 50-50 with a ton of random varying outcomes. The most important stat I mentioned in this video was that the S&P 500 has gone up almost 300 times in price since its inception 67 years ago. All you had to do to benefit from that was buy and hold, nothing more. In fact, caring and trading on things like the September effect is most likely going to lead to a worse outcome anyway. But hopefully you enjoyed my breakdown of the data, and let me know what you would like to see in my next video down in the comment section below. Subscribe if you enjoyed, and consider checking out one of these videos next.